right. Well, good morning and welcome to another Simply Tax Talks. I'm your host, Damien Martin. I'm excited to be here with you today on a foggy day here in Chicago, downtown Chicago, which actually, I don't know if you can hear it in the background. We have our test of the tornado siren in the background. So I guess it's the first Tuesday of the month. So, but any event, I am really excited today because we're joined with two guests that I get the pleasure of working with in BKD Private Client, Bob Lamb and Patricia Quintana-Perron. They're sort of my, we often are in changing messages and going back and forth on, hey, what's going on? And what do we need to be talking about? And hey, what are you seeing on this? And so I'm just really excited about that because tax day is less than 2 weeks away now, believe it or not. And I'm sure for both of you, it's from different angles, right? Patricia on the tax side, Bob on the financial planning side. There's just so much to be talking about right now. So that's really why I'm excited to talk to you both. So Bob, welcome to you. Patricia, welcome to you as well.
Thanks, Damien.
All right. Well, I think what I can't just, I guess, help myself with excitement here. So we're just going to jump straight into our top tax topics for today. So Bob, I know we were chatting a little bit and you had some really good reminders, I thought, for, things just to be thinking about here for 2021. We're always living in the past in the tax world. We're filing for 2021. So what are some things to think about as you're getting ready for filing here in the next couple of weeks, if you haven't already?
Yeah, when I think about this time of year, I really think of it as the folder exercise. And that kind of goes back to it in my house where my wife collects throughout the year everything relevant to the tax year and then brings me a folder and says, okay, please get our taxes filed. And so it's what's inside of that folder that I really look at. And that's going to be, do you have your W-2s? Do you have all of your relevant 1099s? Property taxes, if that's something that you pay. Do you have your charitable contributions? Do you have them all in one place? And so I think that's really the first exercise I always encourage people. Make sure you're organized. Make sure you have it all in put together in one spot to make it easier when you come to visit Patricia or yourself, Damien. And then secondly, have you made, if you're eligible for a Roth IRA contribution or a traditional IRA contribution, have you made those contributions already? If not, be sure you can get those in as soon as possible.
Yeah, those are good things to be thinking about. Absolutely. And I always like it too when the folder is nice and organized. It's an interesting thing. Maybe an exercise in getting to know somebody when you get to work with them on their taxes and how well they are organized, Bob. So I guess I'm going to ask you, how well is that folder organized on your side?
Fortunately, I've assigned it to the right person to make it really organized. So ours is pretty organized, but if it was up to me, probably less organized. So I'm fortunate to be able to delegate that to somebody who's really good at it. So
there you go. Hey, you're a smart man, Bob. I've said that before, but it's all about getting the right strengths deployed here, right?
Absolutely.
So Patricia, I don't know what comes to your mind when we're talking about we're in this home stretch on filing here.
Sure, kind of that underlying fight is always in us tax accountants. We're always looking for that opportunity to take another deduction and looking for a way to maximize the efficiency of a tax return. So this time of year, we're having lots of conversations with our clients and really looking for those opportunities. For example, if you're self-employed, making sure you're taking advantage of home office deductions. And if it's too difficult to gather the information, there's always the safe harbor, which is $5 per square foot up to 300 square feet of your home. Or if you do have the organization of Bob's wife, that you're able to actually take advantage of the pro rata allocation of expenses associated to your business use of the home. So that's always something that we're chasing. And looking at opportunities to do more retirement planning contributions. An SEP is still possible to be done up to the filing of your return, including extensions. So if you need a little bit more time, consider that extension, but that could really maximize the use of that tool. You can get up to $58,000 put into that, depending on whether you have catch-ups and so on, and whether you have a single K that you've used in the prior year that you want to set up before the end of the year for 22. So different ways to take advantage of retirement. Other thoughts that we use with clients is the standard deduction. It's gotten so much higher than it has been in past years. And so with the low interest rate and on mortgage interest and the cap on property taxes and state income taxes. It's getting harder to get over that standard deduction unless you're doing significant charitable contributions. So really looking at whether or not it's best to just use the standard deduction and maybe taking advantage of the above the line charitable deduction, which is up to $600 for married filing joint, and just kind of managing that effectively. But lots of different ways. I can go on and on, Damien, so stop me. Stop me if you need me to stop.
No, I think it's great. I think that there's, and I think maybe that's the sense I'm getting, and I'll ask you this if you're getting the same, that maybe people that I'm talking to almost feel like there's just been so much that's kind of come at us in the last couple of years, both with personal change as well as regulatory and tax and legislative changes, that they're like maybe missing something or they're forgetting to tell you about something. Do you get that sense from people that you're talking to?
Quite often, you kind of have to search it out and ask all the what if questions and evaluate. One of the questions we ask often is foreign accounts and digital assets. I always joke and have this one story of a client that I asked for years if they had foreign accounts, and they're like, no. And then one year they're like, oh, do you mean that account I might have in Mexico? And, it's just those things aren't top of mind.
That would be the one, yes.
Yeah. Having both those types of assets can trigger different reporting requirements, which have pretty severe penalties. So making sure you're taking a look at those things. But yeah, it's been a constant over the last couple of years. This is probably the most normal tax season we've had in 3 years, which is, I think, got everybody on their heels.
It really has. And I feel like that's been the sense I've had too. It's almost like the teams, it kind of almost was looking forward to the fact that we'd have April as being sort of the regular deadline. And I know there's some that have, there's natural disasters that can push things back for others. And that's kind of par for the course anymore, it seems like. But yeah, to kind of have a quote unquote normal tax season is sort of nice, I guess. But you mentioned the foreign asset reporting and the digital asset reporting. That is really important because of the just the penalties that come along with that. And I think it's seeing a lot more of it. And I guess, with that, I don't know, Bob, maybe from your perspective, in the conversations you're having, are digital assets coming up more frequently in the conversations, you think? Or,
I think there's,
where are we with that?
Yeah, Damien, I think they definitely are starting to come up a little bit more. I think people are becoming more and more curious about them, just from the standpoint that becoming more a household name. I think being educated about them, about the pros and cons of them, how they understanding how they work, but also even from a tax standpoint, I think is really important before you hop into that. So being well informed before you make the decision, I think is going to be one of the important things as it becomes more and more prevalent.
Yeah, no, I'm finding the same. And I guess I'll share that our most recent episode of the podcast, episode 143, we had a really great conversation. And I've said it before, I said it on the episode, in fact, that I learned a lot from it. I kind of took a step back and let Nick Farr, who really has made a name for himself in the space at BKD, lead the conversation. And I don't know, I just really upped my game and learned a lot more from it. So if you have questions about it, we'll include a link here in the comments, but check it out, because it really, really helps you better understand what's possible and even what it is. But Patricia, I want to go back to you for a second. We're talking about, obviously April 15th. Technically, it's April 18th this year, right? Because of the way Emancipation Day falls, right?
Absolutely.
And just to, which I think always confuses people, but being nice to us, we're trying to treat April 15th as the day, because obviously there's a holiday in there for many, and so we want to try to be respectful of that on everybody involved. But here's the question: what's the philosophy around filing an extension? Some people always have to, maybe because there's a K1 or something that they're not going to get until later, but I generally get a sense that there's a stigma around extending. So what would you say to that? If I'm coming to you saying, Patricia, I don't really want to extend my return, what would you say?
I hear that often, Damien, and you probably do as well. And, there is no, I guess, truth to the fact that an extension will increase your possibility for audit. There's so many reasons for extensions, life happenings, information's not available. So many of our clients are investing in alternative investments, hedge funds that have K1s that come much later in the year. And so it is quite normal to have an extension. And so the trick that some people think is that it's an extension for everything. You can extend your time to file and your time to pay, which is not correct. you can extend your time to file, but you must pay. You must pay the amount due or you're subject to interest and penalties. So it's very important that you estimate as accurately as you can with the information you have available to be able to pay in what you need to pay in with the extension. And I often kind of suggest clients take a look at the direct pay that the IRS has so that you get immediate proof of payment, especially with all the delays the IRS has been having. There's always that concern that their check is sitting on somebody's desks for days and weeks and months, which is real. It's a real situation given the labor shortage at the IRS. But keynote is payments have to be posted by 8 p.m. Eastern time to count for that day. So don't wait till midnight on the 18th. You got to get it in time, and you can even schedule it in advance. Systems have been known to be down at the service, so making sure you're getting ahead of those things.
Yeah, was that last year, the year before? That certainly happened with the system being down. Yeah. But that's a really great piece of advice. And I think if there's one thing that you walk away with as a listener here, it's if you're making a payment, do it digitally, file electronically. I mean, we talked about in our last session here of Simply Tax Talks, just how much challenge the IRS has really had with it. And again, we can include a link there. It was March 22nd session there. And, they're working on it, but it's just going to take some time. And so the extent that you can make those payments electronically, you can save yourself a lot of headache and hassle with notices and letters and whatnot from the IRS and even the state agencies as well. So I guess, Patricia, that's really a great piece of advice there, I think.
I'd say on the refund front as well, if you're filing on time, there is a place to put your routing information and your account information and select the direct deposit route, which will definitely be much faster than waiting for a check to be processed. In the old days, we say 21 days. I don't know if that's still the case. We'll see. That's still yet to be seen. But it also allows you to use that Where's My Refund app on the IRS website to kind of keep track of where your money's at and when it might show up.
Yeah, another great piece of advice and tip and tools to go check that out. The IRS website I feel like it had some improvements over the last couple of years, and there's some really great tools that are out there that can help you. If you have a question on where is my refund? Well, there's literally a spot. You go to the IRS.gov and it says, where's my refund? And there's a tool there for you. Sometimes it's frustrating because it says, still in processing. Basically, we're working on it. And if that happens for an extended period of time, let one of us know. We can try to help navigate that. In some cases, it's just that they're backlogged or there's things that are going on that's kind of carrying into the year. But like you said, Patricia, I'm hopeful that this year will be a little smooth and those refunds will be faster. But direct deposit absolutely speeds that process up without a doubt.
Absolutely.
But you mentioned making the extension payments, and the other thing that ends up being due is your first quarter estimate if you have to make estimates for 2022. So maybe we'll kind of turn the direction a little bit here and look forward into 22 and beyond. So Bob, maybe I'll go back over to you. What are some things to be thinking about even if it's almost like a checklist or questions to ask yourself for 2022 to kind of make sure you're heading the right direction?
Yeah, I think one of the best ways to make your tax season easy is to be very strategic and planning ahead. And so that's one I know we all work together with different clients. It's one of the things we like to talk to them about. So, I mean, if one is it makes sense to readjust your adjustments or your withholding from your employer. If maybe you paid in too much, maybe you need to back that down, or you didn't pay in enough. That may be an easy thing or adjustment to do. For clients that maybe they haven't maximized the contributions to their 401k, I always like to challenge them to try and increase it every year. And so this is a good time to reflect on that and say, okay, can you add another 1% or 2% or set dollar amount to your 401k to work towards maximizing your contributions there? I think the other thing they'll be looking at is going to be what's your charitable giving plan for the year. Is this the year that maybe you want to do, and I know Patricia references this a lot, of bunching, as she made reference to the higher deduction amount. Is this a good year to bunch, and do you do that every other year? What I mean by that is you maybe give more this year so you can get the higher deduction. And then to do that, are there other ways to be looking at it? Should we be looking at using maybe non-traditional, non-cash assets such as your stocks from your portfolio, giving from there so you get kind of a double benefit there as well? So I think looking at your portfolio, just to make sure that, are you going to be able to maybe harvest some gains or some losses this year? Is this a good year to do that? The other thing we like to walk through is looking at just the Roth IRAs. Is this a good year potentially to be, if you have a traditional IRA, is this a good year to be converting that to a Roth IRA? And if you are converting it to a Roth IRA, be sure and, plan with your tax advisor how much is a suitable amount, how much is the optimal amount without maybe increasing our tax bracket too much. The other thing we talk to clients a lot about that you have to do in the actual calendar year is the two-step Roth conversion. That's where you're going to put a non-qualified contribution into an IRA, and then shortly after convert that to a Roth IRA. And it's just a great way to put additional assets on a tax-deferred and then future tax-free basis. So those are a lot of the key conversations we like to have with our clients. I just think it's the more strategic you are as you look out, and then the more planning you're doing, I think it's going to allow you just to optimize the benefit that the IRS gives you.
Yeah, no, I think that's really great list there, Bob. Honestly, there's so, again, back to that, there's so many things to think about, but there's a lot that everybody's individual situation depends on, right? And Roth versus traditional, and those are conversations really to have with your advisory team. And I think that's what's so great. Again, the way I look at what I do and what we do here as a team is a team, and you should have multiple advisors involved in those conversations. So both the Bob from like the financial planning perspective and a Patricia, right? So I guess with that in mind, Patricia, what would you add to that? And maybe we can unpack even this charitable contribution, this bunching thing that we're talking about, because I know that's been a key planning area that I've had a lot of conversations with clients on lately. So maybe unpack that a little bit as well.
Yeah, absolutely. And then I'll go back to the estimated tax comment you made. I just want to make sure we cover that as well.
Sure.
But that concept of bunching, so because we've got this standard deduction, what is it, 25,000 plus that you can have as married filing joint, as a free deduction. I like to call it a free deduction because it's what the IRS says you can deduct, or you can itemize. When you itemize, you look at your medical expenses once they exceed a certain dollar amount, which is a pretty high threshold, your mortgage interest, investment interest, charitable, and the taxes that are capped at 10,000. So those are kind of the two juxtaposed deductions. So in years that you have, let's say mortgage interest and taxes are your primary deductions, let's say they only add up to 15,000, you're going to want to use the standard deduction. And so what we talk about in bunching is let's not stack on a small amount of charity that year. So let's say you gave 5,000, well, that only got you to 20. You could still use the standard deduction because it's higher. Let's save up our charitable deductions and do them in the alternating year, and maybe do a larger amount into a donor advised fund to allow you to manage that over the next couple of years so that your charities continue to get what they you desire for them to get. But we've bunched the deductions in that year so that we exceed the standard deduction in that year and take advantage of the max deduction the IRS has given us for free in 1 year, and then taking advantage of all the deductions you're truly coming out of pocket for in the alternating year. So we do bunching kind of on an alternating year cycle, or depending on what your charitable desires are as far as funding these types of donor advised funds or charities.
Yeah. Okay. All right. Well, now I'm curious. So what's the comment on the estimates? I just
want to make sure people understood kind of what's required when you do estimates. Because I hear that often. It's like, how much do I have to pay in with estimates, and when do they have to be paid in? And so April 18th, you have an estimated tax payment, and your states as well have estimated tax payments. So if you have state income tax, keep that in mind. You've got a June 15th, September 15th, and January 17th. And what you're targeting is whatever your withholding is not covering to get you to this penalty-proof concept. And the penalty-proof concept is 100% of the prior year's tax, or if your AGI is over 150,000, 110% of the prior year's tax, or 90% of the current year. And so by hitting those targets and doing them as you've earned the income over those quarters, you can ensure that you're not going to be subject to a penalty. So I just want to make sure we tied up that loose end.
Yeah, that's a great one. And I think that especially with some of the things that have changed in this kind of pandemic era that we've been in, with the seasons and the deadlines shifting and whatnot, I think that's really caused some confusion for people
Very
around
much so.
when do I have to do it and how do I have to do it and so
Mhm.
forth, right?
Yeah.
Yeah, and I think the other thing you make a good point, and I'll put my own perspective in here from sitting in the state of Illinois, and I mean there's probably 21, 22 other states that have enacted some similar version of a pass-through entity tax, and an election that you can make at the pass-through entity level, so a partnership or an S corporation, and hopefully you've already thought about that and consider that for 2021, but there's estimates that have to start getting made at the entity level versus the individual level going forward. Again, I could go into a lot more depth. Actually, our future focus webinars that we did a couple weeks ago, kind of a regular Tad Goodenbauer, he was on there talking, and he did a nice conversation on the pass-through entity tax. So I would encourage you to go out and check that out. Maybe we'll link to that as well. Just a little bit more deeper dive on the pass-through entity tax, because there's a lot there. But I don't know, Bob or Patricia, anything else from a 22 perspective that either of you would add at this perspective or at this point in time?
Well, Damien, I think one thing, just really kind of to build off of what Patricia was talking about with the bunching, and using the donor advised fund. This has been kind of a volatile year from stocks, as you can imagine, but we're still on the upper end from a value standpoint. We've had a nice run. This is definitely a year where it may make sense to be cherry picking certain holdings, using actual stocks or mutual funds or other securities and putting them into that donor advised fund to do your charitable giving, which will free up you from a cash flow standpoint as well. So that's definitely a strategy. I know I mentioned a little bit, but just to dive in a little bit deeper on that, I think that's such an important strategy right now and can really allow you to rebalance your portfolio as well. So something I would definitely consider having a conversation with your advisor.
That's a great point, and actually you can have the intersection there with that and the even the retirement perspective. If you're taking RMDs, there's a powerful tool there that you can do around using your RMDs to directly up to $100,000 to directly go to the charity. That can really it's an integrated conversation again around what do you want to accomplish, what do you have in your facts and circumstances, and kind of what can you do within the tax law and the planning. So. Bob, actually, as you were talking there, it reminded me, because you're talking about some of the aspects there around kind of this concept of a personal review, which I know you've talked about. What is a personal review? I guess that, from the conversations we've had, and then what are some things that should be part of it that you would encourage everybody to do as a listener at home?
That's great. I mean, one of the things I always encourage our clients when we're working with them is try and pick a set day of the year where you sit down with your trusted advisors, typically your financial advisor, your CPA. You do a deeper dive on your current financial situation. Maybe you're reviewing your financial plan. You're re-looking at your tax situation, trying to decide what are the things we need to accomplish. And so picking a day of the year that's easy to remember is always a good thing. A lot of times people do that maybe right at the first of the year, or maybe I like to think about April 15th around the tax deadline is a great time to do it as well, because all this stuff is fresh. You have a good idea of what last year looked like. You have maybe some strategy of what your payments will be going forward. And so really sitting down with your key advisors, but looking at, are the beneficiaries on my all my accounts right? When's the last time I looked at my wills or my trust? Are they still relevant? Do they still apply to our current situation? Is our financial plan up to date? Do we know where we're going? Have there been major changes since last year when we looked at them? And if so, how do we make those adjustments? Do we have other large life changes coming up in the coming years? Will we be retiring? Will we have to do RMDs? What does that look like? And so I think it's just an opportunity to really take a deeper dive. And I think we always think, well, yeah, I need to do that. I need to do that. Well, I think if you don't have a set milestone of a time to do that, I think that we all get busy and the year kind of gets away from us. So trying to set a goal, that set milestone of, hey, let's sit down. Maybe we'll give you and Patricia a week off here after 4/15. But after that, then we can sit down and have that conversation of, okay, let's look at the big picture. Is there anything we really we're missing or we need to be updated? Some of the worst to me, gut-wrenching mistakes are the ones where we miss those slam dunks, where maybe the beneficiaries aren't accurate anymore, or ownership of assets aren't the way they're supposed to be, and that can make such a something so complicated. So I think just making sure that those are always taken care of and having a set date to do it is just it's a great exercise to walk through. And I'm sure Patricia has a lot of additional things she would want to add on to that. But
Yeah, absolutely. I think you hit the nail on the head there, Bob, is setting that time aside. It's so hard to, with life being so busy and all these things that we have to be chasing for our families and for ourselves, to really focus on our financial health. So even setting that standing appointment with your advisors, with your investment advisors and your tax accountants to sit down collectively and talk through the different, life happenings that are impacting your life and what that does to your financial condition. Using the tools that you have in front of you, such as your annual exclusions, which are now up to $16,000 a year, the lifetime exemption that's up to $12 million, that reverts back at the end of 2025 to the $6 million-ish amount. It's an ongoing effort to plan. I have so many nightmare stories of estate tax situations that come through our door of folks who thought that they had their estate in order, or maybe didn't realize what needed to happen and just expected their titling to succeed and provide the estate planning they were intending to have happen. So it's essential to get these reviews done and get them done in a way that supports your family and doesn't create a really bad situation when it's already really challenging if you have an unexpected death or a disability that drives your family into a much more challenging perspective.
And Damien, I would add on just one other thing from that is, if you look down the road 3 or 4 years, we know there's going to be some substantial changes from even the estate tax law. I don't think those are decisions or conversations you're going to want to wait until 2025 when the provision sunsets. Those are probably conversations you're going to be wanting to have now and over the next couple of years in order to get things put in place properly. So.
Bob,
that's so true. Go ahead. I was just going to say that, we've been having these conversations with investment advisors, and it's like we've been warned. I mean, look at last year, we had more than 2 warnings, and years before that, the exemption will likely go down. And so we've got some time to plan right now. Let's do it. Let's not wait till it's another fire drill. And then we may not have the opportunity to do it as well as we'd like.
Absolutely. And I think even this is one of the big takeaways I had from, last fall when we were going through the Build Back Better and some of those changes and trying to get some things implemented before that maybe was to be enacted. Obviously, it wasn't, as you know, if you're a regular here and we talked through that, it didn't happen. But, the big thing there that I took away was you really have to be careful because there's so many moving pieces. And like Bob said, right, just a beneficiary designation or updating a trust or one little piece can really have a pretty significant impact. And maybe your mindset's changed a lot in the last year or two. And you really don't want to be just doing it for tax reasons. You have to make sure all of the, what are your desires, your family wishes, your goal for things is reflected in your plan. And that's not going to happen in a fire drill situation. I can almost guarantee you, right, Bob, right, Patricia?
That's a great point. Absolutely, Damien.
Yeah. And probably one last thing I'll just mention on that is, and actually our regular Ted Goodenbauer and Craig Kuchenberg of our National Tax Group, they actually put out an article on the President's Green Book was released last week, or Budget and Green Book were released last Monday. And we have an article out on BKD.com that kind of walks through some of those proposals. Again, they're just kind of on the wish list, I guess I'd say at this point in time. Don't know that we really have the legislative, focus to get there with everything else that's kind of on the agenda. There's lots and lots that's going on in Washington, obviously, and we'll talk about that more in our next session of Simply Tax Talks. But that's a good article of kind of what's on President Biden and the administration's list there. So, maybe with that, let's skip over to our top takeaways that we'll leave everyone with for today. All right, Bob, I want to start with you. And the question I always like to ask is, what are you looking out towards in the next week or two that you're focused on?
I think to me, it's sitting down with clients and making sure they have a clear understanding of what their goals are, what they're trying to accomplish. There's a lot of different noise in the background, and so I think that sometimes can distract us. And so I think we have to come back to understanding what is it that we're trying to accomplish, what's our time frame, and do I have the right strategy, the right risk tolerance in place? And if so, how do I drown out the background noise and focus on what's really important?
I I love it, Bob. We always say that we cut through the static on Simply Tax, and I
Yeah.
I think I'm hearing you say you want to cut through the static of all this stuff that's going on right now,
That's
right?
There you go.
Yeah. Patricia, what's on your mind aside from the list of returns that you're going to be helping people with here in the next 2 weeks?
I hate to say it's as boring as we want to avoid penalties. We want to get taxes handled and get estimated tax payments done and extensions handled, returns filed that need to be filed. But all that is happening. But already I'm booked out probably 2 weeks, 3 weeks post April 18th because we're thinking about planning.
Yeah.
We're looking for opportunities. We're looking at ways and things of impact this year so we can start writing next year's story.
Yeah, and that's a great point. I think that this is the tax filing deadline is actually something. I mean, obviously, I guess I'd have to look forward to it in some weird way, being that I'm a tax accountant, right? But I do enjoy because it gives me an opportunity to interact with so many, and then you start to tee up some of those things and have some of those conversations. Hey, let's book out a meeting in a couple of weeks and let's talk about that a little bit more. And hopefully that's how you're using your advisory team as well as a listener here, because I think that that is the most important part. Getting the forms done and getting them filed and all that is certainly important. But then, what can you do about it and how can you make next year better? I feel like that's what it's all about. And that's why I love listening to and talking to you, Patricia, to you, Bob, and really even the others on our private client team. So I guess that's my takeaway for the week is I'm excited about being part of such a great team here. So, we're kind of at the bottom of our time here. So I want to thank Bob. I want to thank Patricia again. We'll include your contact information in the description below. So please don't hesitate to reach out to either of them. But I guess with that, we'll be back in a few weeks. We're going to go heads down here for the deadline, get some of these tax returns out ourselves. But make sure you tune into that last episode of the podcast for digital assets. I really do think there's a lot there and a lot to understand. So episode 143, give that a listen. Otherwise, until next time, have a great week and thank you for watching.